Welcome to My Finance Teacher. In this short video we're going to look at DuPont identity and its meaning, as well as how to calculate its formula and what it can tell us about the company's operations. And we'll also talk about firm growth and its relationship with firm's dividend policy. These topics build up on the knowledge of ratio analysis, so watching the 3 brief videos on ratio analysis could be helpful. The links are down in the description. Let's start first with the DuPont identity, which tells us that the return on equity, ROE, is equal to the multiplication of profit margin, asset turnover, and equity multiplier. From understanding a little bit of ratio analysis, we remember that profit margin is a ratio of net income, or the profits, to the sales revenue. Asset turnover is a ratio of sales revenue to total assets, and equity multiplier is the ratio of total assets to total equity. Now, in the multiplication of all of these 3 ratios, you will notice that the sales revenue in the denominator of profit margin cancels out with the sales revenue in the numerator of asset turnover. And total assets in the denominator of asset turnover cancels out with the total assets in the numerator of equity multiplier, leaving us with a simple ratio of net income over total equity, which of course is return on equity. So why do we want to complicate this simple ratio of net income to total equity by injecting the additional sales revenue and total assets, which ultimately simply cancels out? The reason is because this can actually give us some additional information on where some hidden problems with running the company might lie if the investors or the managers don't like the return on equity that the firm is experiencing at the moment. For example, if the profitability measured by the return on equity is not adequate because the firm doesn't manage its expenses well, that would show with a relatively poor profit margin. Alternatively, if poor profitability as measured by return on equity results from bad management of assets, for example, having huge warehouses with relatively small sales revenues, that will show in poor asset turnover numbers. Or alternatively, if the company doesn't use as much leverage as optimal in order to achieve a better return on equity, then relatively poor equity multiplier numbers might also indicate where the problem lies. And to throw in the numbers for our particular example, let's say we have a balance sheet at the top of the screen on the left and an income statement at the top of the screen in the center. Profit margin is, of course, the ratio of net income or profits to sales revenue, which is 15% in our case, multiplied by the asset turnover, a ratio of sales revenue to total assets. And equity multiplier shows how much total assets are larger than the amount of equity on the balance sheet. And the product of these 3 numbers is going to give us return on equity, 14.4%, which is of course alternatively a ratio of net income from the income statement to total equity from the balance sheet, 14.4%. Hence we break down this simple ratio into 3 in order to see if possible problems with profitability, if there are any, are due to bad management of costs, bad management of company assets, or a poorly chosen amount of financial leverage. Next, let's talk about the relationship between firm growth and dividend policy. How fast can a firm grow and how it depends on dividend policy. For that, of course, we want to introduce dividend policy where the profits of the company, net income, is divided between the dividends paid out to the shareholders and additions to retained earnings, which add to the equity of the company, helping the company grow. So part of the profits is paid out in dividends. That is called a payout ratio. Let's say in our case that's 33% is paid out. And part of the profits is retained within the company, allowing the company to grow. Let's call it a retention ratio. And let's say in our case it's 67%. Now, in relation to how fast the firm can grow, we can calculate this growth rate starting with the case when the firm is growing solely based on the retained earnings, solely based on reinvesting part of the profits back into the company, without increasing company leverage, without adding on more debt into the company. And that rate of growth would be called internal growth of rate, as the company doesn't rely on any external sources of funding to grow the company size. And the relationship between this internal growth rate and the dividend retention ratio is as follows, where in the numerator we have return on assets multiplied by this retention ratio, and in the denominator we have 1 minus return on assets multiplied by this retention ratio. In our particular example, return on assets is of course net income divided by total assets, that is around 8.2%, and we want to multiply that by the retention ratio, where our numerator is around 0.055, and the denominator is actually 1 minus the amount in the numerator, with the internal growth rate being equal to a ratio of these two numbers, giving us around the 5.8% growth rate per year in the company size. One thing to point out here is that if company relies only on internal growth, as the equity side of the balance sheet is increasing with additional retained earnings every year, the percentage of debt in the total assets is going to decrease gradually, which would change the capital structure of the company. Capital structure is this percentage split between the debts and equity that together add up to the total assets of the company. Now, what if the top management within the firm doesn't really want to change capital structure? That is because capital structure relates to equity multiplier. Perhaps a given percentage of debt within the company size is optimal for a relatively attractive return on equity. In that case, the company might want to adjust this internal growth policy into a sustainable growth policy, where again part of net income, part of profits is added as retained earnings to the equity on the balance sheet, but at the same time the amount of debt on the balance sheet is also increased by the amount which is just enough to keep the capital structure where it is, to keep the split in percentage terms between debt and equity unchanged. In that case, we would refer to a sustainable growth rate, where the formula to calculate the sustainable growth rate is somewhat similar to the formula of internal growth rate, with a bit of a difference where instead of return on assets, we actually plug in return on equity. In our particular example, return on equity is the ratio of net income to the total equity of the firm, all of that multiplied by the dividend retention ratio, giving us 0.097 in the numerator, and the denominator is again simply enough 1 minus the amount in the numerator, where the sustainable growth rate is equal to the ratio of these two numbers, giving us around 10.7% growth rate of the company size per year. And this concludes our brief video on DuPont identity and firm growth versus dividend policy. By the way, before you go, I heard that hitting that like button can be a sign of good luck on your upcoming exams. Have a nice day. Bye bye.